Okay, so you guys sent in some seriously interesting stuff this time around about mezzanine financing and real estate.
Yeah.
And, it's a topic that might sound like super complicated financial jargon at first glance,
Right.
but it's really important stuff when you think about how those really big, like, those massive commercial real estate projects actually get the money they need to get built
Yeah.
without the developers having to, basically give up all the ownership.
Right.
So what we're going to do in this deep dive is really kind of unpack mezzanine financing,
Okay.
figure out how it works, why developers use it, and what it all means for you
Yeah.
when you're trying to understand, the ins and outs of real estate and how deals actually get done.
Yeah, so you're looking at a very specific and a pretty strategic tool that's used in the commercial real estate world.
Okay.
And at its core, it's really about filling a gap in the financing.
Okay.
So, imagine you've got a big construction project. Let's say you
Right.
have the main loan, which is typically called senior debt.
Right.
And then the developer puts in their own money, their equity.
Right.
But sometimes those two sources of funds don't cover the entire cost of the project.
Gotcha.
And that's where this mezzanine financing comes in.
Okay.
It's structured to provide that extra layer of funding without the developer having to, give up a huge chunk of their ownership.
Okay, so let's unpack this hybrid idea because it's not a straightforward loan.
Right.
And it's also different from like bringing in another equity partner who's going to get, part ownership of the building or
Right.
the company or whatever.
Yeah, it's a really interesting blend.
Okay.
Technically, it's structured as debt,
Okay.
which means that it's supposed to be repaid with interest.
Okay.
But it often has this really interesting feature where the lender could potentially get equity in the future,
Okay.
usually through what are called warrants or options.
Gotcha.
So you get that hybrid nature. That's a key difference that you should know.
Okay.
It lets developers get the money they need without immediately giving up equity.
Right.
But because it might convert to equity, later lenders are really incentivized by the project's long-term success.
Yeah.
So it aligns everyone's interest in a really interesting way.
So warrants and options, those are basically giving the lender the right, but not the obligation to buy a piece of the project or the company later on.
Yeah, that's a great way to put it.
Okay.
Think of it as like a potential future share of the profits if everything goes well.
Okay.
And where this financing sits in the capital stack,
Right.
think of it as like layers. You got the most secure money at the bottom and then the riskier investments on top.
Okay.
Mezzanine financing sits below that main senior debt, like the loan from the bank,
Right.
but above the developer's own equity and any preferred or common stock.
Okay.
So in a situation where, let's say the project has some troubles,
Right.
and there's not enough money to go around,
Yeah.
the senior lender, that bank, gets paid first, then mezzanine lender, and then finally the equity holders.
Right. That makes sense why the interest rates are higher.
Exactly.
The stuff you shared said, we could be talking like, teens or even low 20s percentage-wise.
Yeah,
That's a lot higher than a normal loan.
right, it is.
So the lender's taking on more risk,
They are.
so they're asking for more reward if things go well.
Yeah,
But also, they're going to get paid less if things go bad.
exactly. Higher risk, higher potential return.
Yep.
But what's also really cool about mezzanine financing is how flexible it is.
Okay.
You can structure these deals in all kinds of ways to fit the project and the risk tolerance of both sides.
So there was a $100 million project example
Yeah,
to illustrate how this works.
right.
Can we walk through that
Sure.
just to make it super clear?
So let's say you have a development project.
Yeah.
Total costs $100 million.
Okay.
The developer gets a $60 million senior loan from a bank.
Okay. 60% covered.
Yep. And then they put in $20 million of their own money, their equity,
Okay.
but that still leaves a $20 million gap.
Right.
So instead of finding another equity partner,
Would want a big chunk of the profit.
exactly, and maybe a say in how things are run,
Right.
they decide to go for this $20 million mezzanine loan.
Gotcha.
And the example mentioned a 15% interest rate on that $20 million.
Which is high, but
Higher than the senior debt, for sure.
yeah, but that's because of the risk.
Exactly.
And it also included warrants, right?
Yes. So as part of the deal, the mezzanine lender gets the right, but not the obligation to buy a certain amount of equity in the project
Okay.
at a set price in the future.
Okay, so they're getting interest payments like a regular loan,
Uh-huh.
but they could also profit big time if the project takes off.
Right, like an equity investor.
Yeah, that hybrid thing's pretty neat.
It is.
So why would a developer choose to do this?
Well, the most obvious reason is to fill that funding gap.
Like in our example.
Exactly. When the senior loan and the developer's own money aren't enough, mezzanine financing is there to bridge the gap.
And it's a way to borrow more without upsetting the bank.
That's right. Senior lenders, they usually have limits on how much debt a project can have
Right.
compared to its value or costs.
Right, like loan to value and stuff.
Exactly. Mezzanine debt lets developers increase their total borrowing, their leverage,
Right.
without breaking the rules of the senior loan.
Okay.
Like adding another layer of financing on top.
Without messing with the foundation.
Exactly.
So for developers who want to stay in control,
Yes.
this is huge, right?
It is, because if you raise more equity, you're bringing in more partners
Right.
who then have a say in decisions and take a cut of the profits.
Right. Less control and less money for you.
Right, but mezzanine financing lets you keep a bigger piece of the pie.
Yeah. And it lets you do more projects at once, right?
That's another big advantage the material mentioned.
Yeah.
If a developer has a bunch of good projects lined up,
Yeah.
mezzanine financing gives them the money to go after all of them.
At the same time.
Exactly, instead of having to find equity for each one separately.
And it can be faster than finding equity investors.
Yeah, sometimes it can be finding the right equity investors and negotiating all the details.
Yeah.
That can take a long time.
Right.
But mezzanine lenders, they're often specialized funds or private equity firms.
Right.
They can move faster.
Especially if they like the project.
And if they trust the developer.
But there are downsides, right?
Oh, yeah, there are always downsides.
Right.
Well, first off, those higher interest rates,
Right.
those can really eat into your profits.
If the project doesn't make as much as you thought.
Exactly. And then there's the risk we talked about before.
If the project goes belly up.
Yeah, if it defaults on its debt, the mezzanine lender is in a worse spot than the senior lender.
Because they get paid second.
Exactly. They only get paid if there's enough money left over after the senior lender is paid in full.
Ouch.
And there's the chance of equity dilution, too.
Right.
If those warrants or options get exercised,
Yeah.
the developer's ownership goes down.
And the paperwork for these deals can be scary.
Absolutely, mezzanine financing agreements, they can be really complex.
I bet.
Lots of tricky terms and conditions.
So you need good lawyers
You need really good lawyers and financial advice.
to make sure you understand everything.
Exactly. The material really emphasized how risky this can be.
Yeah.
So you have to do your homework.
Really carefully.
Really, really carefully.
You mentioned earlier that it's often specialized funds and private equity firms that do this kind of lending.
Right.
Why is that?
It's because they're the experts in this kind of stuff.
Okay.
And they're more willing to take risks.
Okay.
They have teams of people who understand real estate development inside and out.
Right.
And they know how to evaluate these complicated hybrid deals.
Right.
They're comfortable with the higher risk because they're looking for those higher returns.
Including the equity upside.
Exactly.
So they're more likely to say yes to a project that a bank might turn down.
Yeah.
So what are some other ways to fill the funding gap?
Well, there's preferred equity, which is higher in the capital stack than common equity.
Okay.
It usually pays a more fixed rate of return,
Okay.
sometimes with a chance for more profit a hop.
Gotcha.
It's less dilutive than selling irregular shares,
Okay.
but you still have to share some of the profit,
Right.
but you don't give up as much control as with common equity.
Okay.
And then there are joint ventures
Yeah.
where you basically partner up with someone else to share the investment.
And the risk and reward.
Exactly. And of course, you could always try to raise more straight equity.
By selling more of the project.
Right. But that means giving up more ownership.
And there's seller financing.
Yeah, where the person selling the property helps finance the deal.
Okay.
But that's not so common for big developments.
Right.
So developers, they really have to think about all these options
Yeah.
and decide what's best for their situation.
Based on their risk tolerance and how much control they want to keep.
Exactly.
So let's talk about how these mezzanine deals are actually put together.
Okay.
The stuff you shared talked about some key elements.
Yeah, we already talked about interest rates.
Right. Which can be fixed or floating.
Right. And sometimes they have a pay-in-kind component, or PK.
PK, what's up?
That's where instead of paying interest in cash up front,
Okay.
the interest just gets added to the loan balance.
So the debt grows faster.
It does. And then there are fees, like origination fees for setting up the loan.
Okay.
And commitment fees to make sure the money's there when you need it.
Right.
And of course, those warrants or options we talked about.
Right. The potential equity's upside.
Exactly.
And like regular loans, there are usually covenants.
Yes, covenants are important.
Those are the rules and restrictions.
Right, the things the borrower has to do to protect the lender's investment.
Like what kinds of things?
Well, they can be financial, like keeping a minimum debt service coverage ratio.
Which means having enough cash flow to make the loan payments?
Exactly, or a maximum loan-to-value ratio.
Which is making sure the loan isn't too big compared to the property's value.
Right, and there can be operational covenants, too.
Like what?
Things that restrict the borrower from taking on more debt without permission.
Okay.
Or selling off important assets.
Or changing the project without the lender's approval.
Right, those are all common covenants.
And there's this thing called an intercreditor agreement.
Yes, that's a really important document.
What's that for?
When you have both senior and mezzanine debt on a project,
Okay.
the intercreditor agreement lays out the ground rules between the senior lender and the mezzanine lender.
Okay, so they both know where they stand.
Exactly. It defines their rights, their priorities if things go wrong,
Okay,
and how they'll work together during the loan.
so everyone's on the same page.
Right. It prevents conflicts and makes everything clear and transparent.
And we can't forget those equity kickers.
Like warrants.
Right.
Those are a big part of the deal.
Yeah, it's not just about the interim payment.
Right. The mezzanine lender wants a chance to share in the success of the project.
If it does well.
It.
So there was a case study in the material about a downtown landmark.
Oh, yeah, the Landmark Developers Project.
Yeah, a $250 million project.
Wow, big project.
Yeah, turning an old office building into a mixed-use space with condos, retail, and new offices.
Cool project.
Yeah, they got a $150 million senior loan from a bank,
Okay.
and they put in $50 million of their own equity,
Okay.
but they were still short $50 million bucks.
Yeah, big gap.
So they got a $50 million mezzanine loan.
With a 14% interest rate?
Yep, and warrants that could give the lender 10% equity in the project.
Wow.
So Landmark developers got to build their dream project.
Mm-hmm.
They kept more control than if they'd raised more equity,
Right.
and they set themselves up for a big payday if the project is a success,
And the mezzanine lender, they get that high interest rate.
plus the potential equity upside,
And their loan is secured by the property.
even though it's behind the senior debt.
Exact.
So everyone wins.
Potentially, yeah. It shows how mezzanine financing can be a win-win.
It's a smart way to make these big projects happen.
Exactly. And that's the key takeaway for you, mezzanine financing. It can be complicated,
Yeah,
but it's a really powerful tool for making things happen in commercial real estate.
right. It bridges the gap between debt and equity.
Exactly.
So for anyone who's involved in or just interested in real estate,
Mm-hmm.
mezzanine financing is something you need to understand.
It is.
Because it can be a game changer.
It can.
But you got to be careful
Can do.
and really understand the risks.
And all the details of the deal.
So thinking about all that,
Yeah.
when do you think mezzanine financing makes the most sense for developers?
Good question.
What kinds of projects or market conditions make it the best choice?
That's worth thinking about.
And when would those other options like raising more equity or getting preferred equity
Right.
be better?
It really depends.
Yeah.
There's no one-size-fits-all answer.
But it's something to consider as you're learning about all this stuff.
Absolutely.
Thanks for diving in with us.
My pleasure.
And keep those questions coming.
We love them.
We'll see you next time on The Deep Dive.
See you then.